Real estate assets go beyond owning shares in publicly traded real estate businesses. In fact, while U.S. financial real estate assets, or the real estate equity sector, was valued at $1.4 trillion, the total value of the U.S. housing market, or physical real estate assets, reached an all-time high of $47 trillion in June 2023. Owning physical real estate assets involves buying a house, rental property, or land. Meanwhile, owning financial real estate assets involves buying shares of related businesses on the stock market. Physical real estate asset returns come in two forms: regular payments from renters or rental income, and capital gains or the surplus of the selling price over the buying price. Physical real estate assets fall into 5 buckets. Residential real estate includes single-family homes, condos, cooperatives, duplexes, townhouses, and multifamily residences. Commercial real estate includes apartment complexes, gas stations, grocery stores, hospitals, hotels, offices, parking facilities, restaurants, shopping centers, stores, and theaters. Industrial real estate includes property used for manufacturing, production, distribution, storage, and research and development. Raw land includes undeveloped property, vacant land, and agricultural land such as farms, orchards, ranches, and timberland. Special use real estate is public use land like cemeteries, government buildings, libraries, parks, places of worship, and schools. The number of new residential construction or housing starts is a key indicator of the health and direction of the physical real estate market, which is governed by supply and demand. Construction is materials and capital intensive and usually funded by loans. So inflation and interest rates significantly impact real estate values, as you can see from the yellow and gray lines on the housing starts and interest rate charts, both representing recession. Rising inflation increases building costs by raising materials and energy prices, as well as construction workers' wages. This reduces housing supply and inflates existing and new home values. Moreover, rising interest rates, which usually follow rising inflation, increases building project loan costs, which further reduces housing supply and inflates existing and new home values. If high interest rates persist for long enough, it eventually destroys housing demand and cuts existing and new home values, as it slows down the overall economy, leading to cuts in business borrowing and operations, wages and jobs, while boosting mortgage and rent payment failures or delinquencies. Now let's see how things stand in the physical real estate markets of a few major economies. Yes, housing prices surged in the US in the last few years, but have you seen Canada? These charts by Ben Carlson show that Canadian housing prices rose a whopping 142% since 2005, and that's after adjusting for inflation. Meanwhile, US real housing prices have only gone up by 26% in the same period. To get back in line with US real housing price growth, Canadian housing prices would need to collapse by about 40%, and that would be brutal for existing and new homeowners. Moreover, the Canadian housing anomaly is the same on a year-by-year basis, where we see bigger gains and losses in Canada compared to the United States. Things get crazier when you pit the real gains in housing prices against the real gains in disposable income since 1975. In the US, over the last 50 years, the relationship between incomes and housing prices after accounting for inflation has been close and fairly stable, but the Canadian housing market has gone haywire in the last 2 decades or so. Eurozone interest rates had been near 0% since 2015, but rose rapidly to 4.5% beginning in 2022. One of the results is the bursting of the German residential property bubble with 4 consecutive quarters of decline, the last of which was the largest quarterly slump since records began in the year 2000. The German property crisis has already claimed Austrian property giant Signa, which had significant operations in Germany and filed for bankruptcy in November 2023. Right, that does it for the real estate asset class. Next, we'll delve into the commodity asset class.